Hey, what's up everyone? Welcome back to the channel. If you're new here, your go-to guide for smarter financial decisions, especially when it comes to retirement. And today, we're diving into a question on everyone's mind. Should I retire now or wait? It's not a simple yes or no. There are real pros and cons to consider, and I'm going to walk you through both sides, step by step. Whether you're thinking about retiring this year or just exploring your options, this video could save you from a decision you might regret or help you retire with confidence. Before we jump in, if you're looking for easy-to-understand financial tips, strategies, and all the hacks you need to make the most of your money, make sure to hit that subscribe button and turn on notifications so you don't miss any of the awesome content coming your way. I have a lot of questions that people have sent me, and I'm going to go through them one by one and answer each of them. This way, it'll be easier for you too, to better understand your own retirement and make informed decisions. The first question comes from Mr. John, who's from California. He's asking, throwaway account here. I, at 57, am a Fed that's past my MRA and have 30 plus years in. I'm eligible for retirement now, but initially planned to continue for a few years. Now I'm trying to figure out if I should go ahead and retire now. Let me know what I'm not considering here. Let's break this down. Here are the pros and cons you need to know. And then we'll move on to the next question.
Pros.
Our financial planner says we can manage it. My husband has a steady, reliable job in the medical field. Congress is considering changes to the FERS retirement plan. If I leave now, I avoid those changes before they go into effect. My current team and management may change for the worse. Budget cuts are already reshaping the structure. Leaving now would protect my mental and physical health. I'm feeling burnout, and this could bring relief. Remote work policies are getting stricter, possibly Orwellian. I'd rather leave before things like keyboard tracking become real. I know remote work may end altogether soon. I'd prefer to exit before those policies fully hit. Right now, staff exists to process my retirement paperwork. But with ongoing cuts, I'm unsure they'll be available later. Will future retirements even be processed on time? Better to go while the system still functions. Performance standards might become stricter. Even with great appraisals, it adds pressure. I could leave before those changes affect my retirement. And I could give back, using my skills through community volunteering. Leaving now might open a slot for someone else. Someone who still needs to keep working. If I go now or even just start the process, I may avoid complications during a shutdown furlough.
Cons.
I truly love my work. The mission of the agency means a lot to me. I feel proud knowing my work benefits the public. I will definitely miss that sense of purpose. If I leave, my position might be eliminated. There's a chance the role won't be filled again. I also worry about leaving my coworkers behind. They may be stuck with extra work in my absence. We'd lose my income, which would tighten our finances. It wouldn't be impossible, but it would be noticeable. I have seniority and could likely survive a RIF. By staying, I could push out someone with more years to go. My health might improve after retirement, but I may also feel like I quit too early. I worry I'll regret the decision and feel emotionally conflicted about retiring this way. What other factors am I missing here? Any advice? To everyone listening, if you've been through something similar or have any advice, feel free to share your experience in the comments. You never know, your words might help someone else who's going through the same thing. A lot of people reacted to these pros and cons, and I'm going to share all of those reactions with you.
Some told me,
prepare for an immediate MRA retirement because of legislative shenanigans. One of the things I was told by a colleague was to make major purchase the few years prior to retirement. Do you need a new car, new appliances, new computers? If so, I'd be considering doing one of these then retiring. Every Fed is going to be shafted with additional work shortly because of insane inbound RIFs. And I'll also share what one more person had to say. I'm in almost the exact same position that you are in, except I think you like your job a little bit more than I do. I decided to retire back in November, and I was planning to leave in a month or so. Yesterday, I contacted my retirement specialist and asked to move this up to the end of next week. I think you should retire. I was not willing to stay and start going back in the office 5 days a week. Now, I'm worried that even though I have 30 plus years in the job, I'm considered non-essential, so I don't feel safe. Also, you mentioned working as an usher. I had a coworker that did that after he retired, and he absolutely loved it. So, it's not a weird idea. Maybe think about taking a job with good perks. I know a couple of people that retired and then went to work for an airline, and now they fly for free. Alright, let's set all of that aside for a moment and talk about some mutual funds that are actually sponsoring today's video. Today, I'm going to break down how mutual funds work, why they're such a great option for US retirees, and I'll even walk you through some of the best funds to consider right now. And by the end of this video, you'll know exactly how to build a plan that can take you from living paycheck to financial freedom. Alright, let's start by talking about the problem. A lot of retirees get stuck living on a fixed income. Social Security benefits, like SSI, are great for covering basic living expenses, but they don't leave much room for anything else. Let's say you're getting $1,200 a month. After rent, utilities, groceries, and healthcare, you're barely scraping by. And what happens if an emergency hits? Or if you want to travel? Or just have a little fun? These things can seem impossible, right? But here's the thing, there's a solution, and it's not some crazy get-rich-quick scheme. It's simply understanding how your money can work for you, instead of just sitting there. And that's where mutual funds come in. Now, you might be thinking, I've heard of mutual funds, but how do they actually work and why should I care? Great question. Let's break it down. At its core, a mutual fund is a pool of money that's collected from multiple investors and then invested by professionals in different assets, like stocks, bonds, or real estate. The best part? You don't need to pick the investments yourself. Someone else is doing the heavy lifting for you. So, it's kind of like a financial team working behind the scenes to grow your money. For retirees, this is powerful because it gives you access to a diversified portfolio with relatively low risk. And since mutual funds are designed to be long-term investments, they're perfect for building wealth over time, something you absolutely need in retirement. It helps you get the returns you need while reducing your risk. Alright, now let's talk about something that's crucial to building wealth, compound interest. It's the secret sauce that turns small amounts of money into big amounts over time. Let's say you start with just $1,200 a month, your SSI check, and invest it in a mutual fund. Even if you don't add more money over time, that initial investment can grow.
How?
Because the money you earn from the fund, interest, dividends, capital gains gets reinvested into the fund, and then it starts earning returns on those returns. It's like a snowball effect that gets bigger and bigger as time goes on. And the best part? This works even if you don't have a huge amount of money to start with. The earlier you start, the more you'll benefit from compound interest. Now, let's dive into some of the best mutual funds retirees are using to grow their money and secure a steady income stream. These are the funds that have a proven track record of steady returns and are perfect for someone looking for stability in retirement. Alright, so now you know the power of mutual funds. But how do you actually start using them to build your wealth? Here's a step-by-step guide that will walk you through the entire process, from setting up your account to getting those sweet returns. Let's break it down. The very first thing you need to do is open an investment account. You can easily do this with an online brokerage such as Vanguard, Fidelity, or Charles Schwab. It's super simple, and all you need is a few basic details to get started. Here's what you'll need: your personal details, name, address, etc. Social Security number for tax reporting. Bank account information to transfer money into your investment account. Choose a brokerage that offers low fees and has good customer support. Vanguard and Fidelity are popular choices for retirees. Once your account is set up, it's time to choose your mutual fund. Now, remember, there are a lot of mutual funds out there, but you want to choose one that suits your risk tolerance, income needs, and time horizon. Here are some things to consider. Risk tolerance. If you're conservative, look for funds that focus on income, like bond funds or dividend funds. Investment goals. If you want long-term growth, stock market index funds like the Vanguard Total Stock Market Index Fund, VDSAX, are a great option. Income needs. If you need regular income, Fidelity Income Fund, FSTFX, and Vanguard Wellesley Income Fund, WINCS, are designed for just that. Here's the beauty of mutual funds. You don't need a lot of money to start. In fact, some funds let you begin investing with as little as $500 or $1,000. This is a big advantage for retirees, especially those relying on SSI or fixed income. Pro tip: start with the minimum required investment, then gradually add more as you get more comfortable with the process. So many retirees are still unaware of what VWINCs, FSDFX, and VTSEX are, so let me simplify it for you. These are mutual funds that can help you build wealth, generate steady income, and secure your retirement. Here's a breakdown of what they are, their history, and how they can benefit you. What is VTSEX? VTSEX is a mutual fund offered by Vanguard that's built to track the entire U.S. stock market. It's known as an index fund because it mirrors the performance of a specific market index, the CRSP U.S. Total Market Index. This index includes companies of all sizes, from small cap to large cap, giving investors exposure to the full U.S. market. How does VTSEX work? VTSEX spreads your investment across thousands of companies from many sectors. This broad diversification means you're not relying on the success of just one company or industry. It holds everything from major tech firms like Apple and Microsoft to smaller, fast-growing businesses, helping reduce risk while offering long-term growth potential. Low expense ratio. VTSEX stands out for its low expense ratio. At just 0.04%, it's among the most affordable ways to invest in the U.S. market. This low fee means more of your money stays invested. Less is lost to management costs, which helps grow your savings faster. How VTSEX benefits retirees. For retirees aiming to build long-term wealth, VTSEX offers solid growth potential. It has a strong track record of delivering reliable returns over time. That makes it a smart choice for those who can stay invested for years. Even though the stock market can be shaky in the short run, VTSEX usually trends upward in the long run. It gives retirees market exposure without needing to pick individual stocks. It also helps balance a portfolio while aiming for steady, long-term growth. Low expense ratio. One of the biggest advantages of VTSEX is its extremely low expense ratio. At just 0.04%, it's among the most affordable ways to invest in the U.S. stock market. This means very little of your money is lost to management fees. More of your investment stays in the fund, helping it grow over time. How VTSEX benefits retirees. VTSEX is a strong option for retirees who want to grow their savings steadily. It has a solid history of long-term returns. If you're able to leave your money invested for years, it can really pay off. Even though markets can be unpredictable in the short term, VTSEX has shown consistent growth over time. This makes it great for retirees who want stock market exposure, but don't want the stress of picking individual stocks. It brings balance to a retirement portfolio while offering solid growth potential. Moderate risk. FSDFX carries less risk compared to stock-only funds like VTSEX because it focuses more on bonds. Bonds are generally more stable than stocks, so the value of the fund doesn't swing as much with market changes. At the same time, it still includes some stocks, giving investors the chance for modest growth. How FSDFX benefits retirees. FSDFX is a strong choice for retirees because it's built to deliver steady income. Whether you're using it to help with daily expenses or to add to your Social Security benefits, the fund's regular payouts can offer financial stability and peace of mind in retirement. Lower risk. FSDFX carries less risk than funds focused mostly on stocks. Because it's bond-heavy, its value tends to be more stable. For retirees who want limited volatility, but still some growth, FSDFX can be a smart and dependable option. What is VWINCs? VWINCs is a mutual fund offered by Vanguard. It's considered a balanced fund because it invests in both stocks and bonds. However, it leans more toward income-producing assets. About 60% of the fund is in bonds, and the rest is in stocks, mostly dividend-paying companies that offer steady income. How does VWINCs work? Balanced approach. VWINCs follows a balanced strategy by investing in both stocks and bonds. This mix helps the fund earn income and still benefit from stock market growth. Bonds in the portfolio add stability and reduce risk. Meanwhile, the stocks offer a chance for growth, mainly through dividends. Focus on income. Like FSDFX, Winx aims to deliver steady income. Bonds in the fund pay interest regularly. The stocks included are mostly dividend-paying, which helps generate ongoing cash flow for investors. How Winx benefits retirees. Stability with growth potential. Winx is a solid option for retirees who prefer a conservative approach. It offers stability through bonds and growth through stocks. The bond portion helps steady the portfolio. Meanwhile, the stocks offer exposure to market growth. Regular income. Like FSDFX, Winx delivers steady income. It earns this through bond interest and stock dividends. What sets it apart is its balance of both asset types. This mix creates a more well-rounded retirement portfolio. Which one is right for you? If you want long-term growth and can handle some risk, VDSEX is worth considering. It invests across the entire U.S. stock market. Over time, it offers strong return potential, perfect for growth-focused investors. If you're looking for steady income and prefer a more stable, low-risk investment, the Fidelity Income Fund, FSDFX, is a strong option. It mainly invests in bonds and dividend-paying stocks. This setup helps provide consistent payouts with less market volatility. For those wanting a mix of income and moderate growth, the Vanguard Wellesley Income Fund, Winx, is a great alternative. It offers a balanced strategy, less risky than pure stock funds, but still with room to grow through equities. It's ideal if you want some stock market gains without full exposure to its ups and downs. When you invest in mutual funds, you'll earn income through dividends or interest. Here's the important part. Reinvest those earnings. Instead of taking the cash, use it to buy more shares of the same fund. This strategy accelerates growth through compound interest. Think of it like adding fuel to a fire. The more you feed it, the larger it grows. Let your money keep working and building on itself over time. Let's talk about managing risk. Yes, mutual funds come with some risk, but diversification is your strongest defense. By spreading your money across different asset types, like stocks, bonds, and even real estate, you lower your chances of facing big losses. One smart move is to diversify your portfolio. Don't put everything in one type of fund. Mix stock funds with bond funds to balance things out. This helps reduce sharp ups and downs in your investments. Also, stay calm during market dips. If prices fall, avoid the urge to sell right away. Be patient and let experienced fund managers handle the ride. Markets recover more often than not. And as you get older, adjust your risk level. The closer you are to retirement, the more important it is to move into safer investments. That's why funds like the Vanguard Wellesley Income Fund, Winx, are popular with retirees. They combine stocks and bonds to offer steady growth with reduced risk. Now, here's the big question. How do you actually use these funds to build real wealth and work toward financial freedom? Even if you're starting with a small amount, consistency is key. Set aside a portion of your SSI or retirement income each month. The sooner you start, the more time your money has to grow through compounding. As you move closer to retirement, your strategy may need updates. Review your mutual fund choices every few years. Make sure they still match your goals and your comfort with risk. Mutual funds are designed for long-term progress, not overnight results. The longer you stay invested, the better your chances of seeing meaningful returns. Slow and steady truly wins the race. If you plan to use mutual funds for income and retirement, look for funds that offer reliable dividend payouts. Fidelity's Income Fund, FSDFX, is one example. It pays monthly, quarterly, or annual dividends. These payments can help you cover regular living expenses in retirement. Each fund serves a different purpose. That's why choosing the right one depends on your personal goals. For long-term growth, VTSEX is a strong pick. For income, FSDFX and Winx are smarter choices. FSDFX focuses on low risk, steady income. Winx offers a balanced mix of growth and dividends. Decide what matters most: growth, income, or balance. And for extra security, consider spreading your investments across multiple funds. So there you have it. Mutual funds can help you move beyond just surviving on SSI. They give you a chance to build real, steady income over time. With patience and smart choices, you can work toward a more comfortable retirement, without relying only on Social Security. The most important step is to start now. It doesn't matter if you're starting small. What matters is building the habit and letting your investments grow. And if this video helped you, don't forget to like, subscribe, and leave a comment below. Tell me, what's your biggest challenge with investing or retirement planning? Let's start a conversation. Disclaimer: this video is for informational purposes only. It is not financial or investment advice. Please consult a licensed advisor before investing. All investments carry risk, including loss of principal.